Hi, everybody. Welcome back to another episode of the Discovering Multifamily Podcast. I'm your host, Anthony Scandariato with Red Knight Properties. And today we have a special guest here with us, Dina Buchanan. And Dina is the Director of Investor Relations at PCRP Group, which is a company that offers direct access to tax-advantaged passive income commercial real estate investments. And similar to what we discuss on the show and what my company does as well, is they invest in high-demand multi-housing communities, but they do it in a little bit of a different way in terms of how they're picking the communities and their investment criteria. They're choosing climate resilient markets, which can give investors more layers of investment security. And in the long haul, obviously, that will lead to greater returns. So we want to talk about that specific aspect when you're evaluating commercial multifamily properties and why they chose to focus on those types of markets and what that actually means. So really excited to have Dina here, and thanks for coming on the show.
Thank you so much. It's a pleasure to be here.
Great. So you've had 19 years of experience in both residential and commercial investing, and
Yep.
right now you guys have $200 million under management. So I want to understand a little bit more about the climate resilient portion and kind of how that relates to a lot of the initiatives you're seeing going on in the country. So definitely want to
Absolutely.
hear more about that. And you.
For sure. I started out in residential real estate over 19 years ago. My husband and I, probably very much like a lot of people out there, we wanted to own more of our time, and everything that we checked out from franchising to other businesses. We both went to school, had the degrees, got into higher paid careers. And wanted to start a family and wanted to have more time with our family and love to travel and do things more to our, have that time freedom to do it our way. And that's really what led us into real estate. And I always joke that we loved residential and we did very well with it. And then we did our first apartment building. It was like a 27 unit. And that's when we got bit, right? That's when it was like intoxicating. It was like, oh my gosh, we started to see how much more you can exponentialize returns doing multifamily than just single family, as far as cash flow, diversity, tax advantages, the whole nine yards, as you know, because that's really the crux of what we're talking about today. But one of the things my business partner and I recently, I would say in the last couple of years, we have been looking at, well, gosh, there's a lot of talk about climate extremes. And when we talk climate resilience, let me be really clear, we're not on a climate change debate with that topic. That's a lot, debating it politically is a lot different than looking at managing risk. And the facts are clear, the numbers are in that there are certain markets in the country that are considered very good markets. I'm in Orlando, Florida, for example. So that would be something we would consider more climate resilient versus, Miami Beach, Daytona Beach, New Smyrna Beach area, because those are coastal. So climate resilient markets are simply markets that are not as subject to weather diversity or climate patterns, catastrophes that we're seeing, fire, floods, droughts, heat waves, things like that. So it doesn't mean 100% those markets don't see any inclement weather or any, possibility of that, but it's a much lower probability of it happening there. Does that make sense?
Yeah. So Dina, with that being said, could you talk about some of the states where your portfolio is in and some of the regions and some markets within those states that aren't
Sure.
really prone? Because we own in, we're about to own in Orlando ourselves. So
Fantastic. Well, that's a good one.
yeah.
So, we look at the Carolinas, that non-coastal, we'll look at Tennessee, Kansas City. We also do Colorado Springs, Atlanta area, not necessarily in town Atlanta, not that that's bad weather-wise, but just, around anywhere from Macon on up north. And these markets are good markets that produce really good returns as well as some of the others. But the big thing with climate resilient, and this is where it really comes into play with the numbers, is first of all, let's talk insurance. We have already started to see in the residential realm, insurance companies dropping people because of the area they live in. And maybe when they bought their homes, they didn't see it as a flood zone or a fire prone area. And now insurance companies are dropping, and we're starting to see this trickle over into the commercial side. And this is going to be a huge issue if multiple insurance companies start dropping or won't insure in those areas. Because if there's no insurance, there's not going to be any underwriting from mortgage companies. You've already got people like BlackRock, State Street Capital, and other companies that are starting to look at, hey, not only where is this company investing in today, but let me look at their portfolio from the last 5 years and see where they're invested in currently, because they're going to look and say, wow, if these properties are not in areas where they'll be insurable, this could be catastrophic for investors and the company itself. Does that make sense? And we're seeing, I don't know if you've heard about this, but we've been seeing a lot of it. And it's really been a vehicle that's been driving us into, basically more inland, and out of the way of Tornado Alley, and certainly not in, earthquake zones and things like that. So those are really primarily, it's not about where we'll go as much as it is where we won't go.
Right. So can you talk about that from you're talking about from an insurance perspective too? A lot of carriers are, dropping in entirely areas within, high flood zone categories and whatnot. I guess my question to you is, can you still make money and do well if you're in a flood zone? Because, you're using Florida as an example, and we invest in Florida as well.
Right.
So a lot of money that has been made on the coast, on both the East Coast and the West Coast.
For sure.
How do you manage that risk more when, even if you are targeting assets on the coastlines, or do you just, moving forward, you're trying, it seems like you're avoiding it entirely, but there are investors who kind of still see it as an opportunity because not as many people are looking at it.
Well, again, it's really about, for us, aligning with our investors' needs and protecting them. So I have very good friends that are investors that are investing in the southwest coast of Florida. And I love them personally and professionally, and they're great people. But our company, PCRP Group, would not fund for that with our investor funds, simply because the risk is too high for us. If insurance companies aren't insuring there, you might end up getting one or two that will insure there, and that's going to jack the rates up really, really high. And that's going to offset, a lot of the costs, things that maybe they ran numbers on that looked good initially, maybe in 2-3 years won't look that good, depending on, how the weather patterns go. So however we feel about what's going on, with, the great debate of our generation, the numbers are clear, that properties that are in more climate resilient markets are going to have a higher probability of reaching their full potential on that investment.
Right. Okay. So what factors are you looking at in order to, and how can investors do more due diligence? Obviously, Florida has a website where you're able to, kind of track even storm patterns and hurricane patterns and whatnot, even flood zones. Is there how do you guys conduct diligence when it comes to the climate risk? Is there a program you use, or kind of a one-stop shop per different states, or how do you evaluate that risk?
Well, we look at, we don't do anything coastal right now, because we know that particularly, and these are things that are very obvious, obviously, when we're looking at weather patterns on the coast, that would not be an area that we would go into, regardless of, we're not just analyzing the numbers in a deal and the return and the tax advantages. We do a comprehensive risk analysis, and we've got a risk analysis team that determines, as we're doing our due diligence on an opportunity, really what's going on in that area, and is it something that's more climate resilient? Is it something that, in other words, in the middle of Atlanta, Georgia, there probably is not going to be a hurricane, right? So, but now if we go down to the coast of Georgia, it could happen there. So it's not about will it happen there, right? It's if it could, it's going to put a higher risk on our projects with our investors. And so we would just stay away from that area.
Understood that. And is that knowledge that you've just obtained over your 19 years in the business of where to invest, where not to invest? Have you been burned before when it comes to the environmental risks?
No, we have not been burned before, but our Mike Warren, one of our team members, he specializes with environmental, social governance, ESG, and he is our risk analyst, one of our risk analysts, and he has had years of experience with understanding this phenomenon. And it is, when you see the bigger guys looking about where they're gonna, invest or not invest, it definitely is a wake-up call. And this is happening whether people are looking at it or not, whether other companies are looking at it or not. Risk analysis is going to include climate risk analysis as well. So it's probably pretty easy to look at a map of the United States and determine where, if you watch the Weather Channel one day, you'll probably see what's going on in the country and which areas get hit the most. And we would probably move to the other side of those areas. Does that make sense?
Yeah, it makes a lot of sense to me. And for us, we stay out of the coastal areas for that reason as well.
I'm sure you do. You're smart.
And so can you talk a little bit, you mentioned the social governance topic. Can you talk a little bit more about that from a real estate perspective?
Yeah, absolutely. So one of the things that is very attractive about multifamily is it literally reduces the carbon footprint. So if a group of investors like PCRP Group or your group, when we look at purchasing multifamily, which is mainly what we do, we will go ahead and look at the fact that, number one, when we go in, we'll get a Class B, and we've got a really good opportunity to upgrade, and we can use environmentally friendly materials, which cost just about the same as doing a regular renovation or upgrade. And our tenants on the properties will love it because it's more energy efficient. If we can put them in, an area, if we're in an area where it's going to have mass transportation or public transportation, parks, recreation, that's going to really reduce the carbon footprint. And it's also going to create more of a tax advantage for those things. So we call it doing good while doing well. So we're doing really good things for our tenants and the environment. We're also doing really well for our investors because we'll be able to enjoy some of those tax advantages that we can get from using these types of products and doing these types of projects. We've discovered also that the upside on this type of a project is quite a bit higher in the returns department. I always hate to quote numbers on gauges, but on some of these projects that we're looking at, just to give a range, we're seeing anything from 10 to 16% on average higher returns in those type of markets using those types of strategies, which I just discussed.
Right. And so if you're buying existing multifamily, what sorts of strategies, it depends what type of asset class you're buying within multifamily, but what are some of the initiatives that your company is taking to reduce the carbon footprint and take advantage of, like you mentioned, some of the tax advantages and other rebate programs? Can you name a couple of those things? So
well, we normally, now our group, we align with sponsors that do just that. So each sponsor has a different, maybe setup or take on the design and as far as how they're going to analyze their market. But we stick with sponsors who will focus on Class B. And why we like Class B is because there's always going to be a good upside. In times when the market is riding high, like right now, you've got a lot of build to rents, and a lot of Class A communities are doing quite well because it's, right now. But what we look at is tomorrow, those Class A's, the people that are in those, if there's a downturn, and there's always a downturn, they're going to be more prevalent to go to a Class B, which is probably a 10 to 20-year-old community. And if it's got all the upgrades that we're talking about, and we work with sponsors that do align with our goals and our values when it comes to being more climate resilient, those are very attractive to our investors. They are like, wow, this is great, because not only we're getting the standard that multifamily opportunities provide our investors and our money that's in there, but we're also getting this overall savings on the project because they are getting some tax advantages that are different than the norm because of what they're using. So this rolls right back into the profit margin for our investors. And our investors are loving that, because they too get to realize, the better the deal does, the better we all do, as you know. So we set our deals up to give us the highest probability of reaching that full potential.
Yep. No, totally understood that. Dina, how can my audience find you, learn more about your company, and connect with you?
Oh, go to our website, PCRPgroup.com. And I encourage all of you to download. We got a lot of education on all the topics we discussed, as well as investing and being an accredited investor and investing in multifamily. And it's all complimentary information. You can download our free ebook and become part of our passive investor club. We're going to do a webinar series on this very topic that we talked about today, and other ways that our investors can really capitalize and have their money work harder for them so they don't have to.
Great. Excellent. And if you
My
like
contact info is on the website as well. So anybody's welcome to schedule a call with me or email me, and I'm happy to set up a time and chat with anybody that's interested in doing that.
Excellent. And we'll have a link to Dina's website and other channels in our social media description, so you could feel free to reach out to her directly. And if you liked what you heard and or saw today, if you could please give us a rating and review on iTunes, we would really appreciate it. It would help Dina and myself get our message out to a greater audience. So we really appreciate that. And Dina, thank you again so much for coming on our show. It was really insightful, and I look forward to talking to you again soon.
Yeah, excellent. Have a great day.
You too.